Good morning, everyone. Thank you for joining us for part 2 of our webinar series on the CARES Act and the benefits for small business. My name is Mark Heath. I'm a partner here at McKonly Asbury, and I'm Director of Tax Services. And with me today is David Blain. I'll let David Blain introduce himself.
You just did it. I'm David Blain. I'm the Director of Entrepreneurial Services at McKonly and Asbury. Welcome, everybody. Good morning. I hope everybody's excited for part 2 of the CARES Act.
I know I am. So we've got a ton of questions over the past few days asking, how do these things apply to me, to my company? How do the different options interplay? So today we're going to try to cover all of those questions and just share some insight from what we've seen working with clients, friends, banks, to make sure everyone is able to gather all of the information that they need to get these loans, to get them forgiven in the case of the PPP loan, and to make sure they can figure out what works best for them, because there's a lot of companies out there where the Paycheck Protection loan is the best option. There's plenty of companies out there where that's just not the best option. We're going to tell you how to use both of them, how to use one or the other, and to go over all of this stuff. So we're going to get everybody up to date. We're going to go over the EIDL, the Economic Injury Disaster Loan, that's being administered through the SBA. And like I said, we're going to compare the two.
All right. So we're going to start with just a couple lessons that we have learned since our last webinar. And it seems like that last webinar, Mark, we did was about 10 years ago. With all the changes,
feel that way. Yeah.
With all the changes that we saw from Tuesday, March 31st to the day, with the different the multiple changes that came out from U.S. Treasury, from the SBA, and then late Thursday night last week when the SBA sent out their quote interim final rule on this Paycheck Protection Program. So with the number of different moving parts and the number of clients that we were working with to help them with the application process, a number of questions and just things popped up in regards to how the banks are handling things, how they're doing things differently between the banks, some of the guidance from the SBA, just a lot of different things. One thing we do know, though, Mark, is that a lot of banks are moving very quickly with the application process right now. I mean, we know that there's a lot of local banks here in the mid-state area that opened up on Friday, had processed numerous applications Friday night over the weekend, and they're moving very quickly, a number of the local banks here. And with that, we saw a number of the larger banks, M&T, PNC, Wells Fargo, opening up their portals and their processes. So we do know that they're moving very quickly at this point in time to try to get this money out to the hands of the small business owner.
Yeah, there's been a lot of criticism of the banks, and not necessarily unwarranted. But I will say, the banks are in an unenviable position here, where they had 300, 800, however many pages the CARES Act was dropped on them, and told to administer it in like 72 hours. And then literally 12 hours before they were supposed to open the portal, they got a whole set of rules that a lot of which contradicted what was in the CARES Act. So I don't envy the banks. And that's where we saw, the smaller banks, the credit unions, the community banks, they were able to adjust and move more quickly, obviously, because they're smaller. The bigger banks, it's turning a ship around to try to get them moving. But the good news is that everything seems to be moving. A lot of the frustration and questions that we're hearing from clients is where they simply don't understand the rules. They don't understand how their company is taxed, because they've been running their company and they rely on their professional service advisors to handle things. So there are a lot of nuances there that you need to understand about your business and how you apply for these things, and we're going to be covering those. Right. So the Paycheck Protection loans, that's the big shiny thing that's out there right now. The purpose behind those is to keep people employed. So if you have employees that you've had to lay off because your revenue stream went to zero, the point of this loan is to bring them back on payroll, get them off unemployment, bring them back on payroll. We've heard from clients, from friends who they say, well, I don't have any work for them to do. They don't care. The point is to get them back on payroll so that when this thing does end, that they're back on payroll, they're employed, and as soon as the economy can start back up, that they're there ready to go, push the button, flip the switch, and start serving your customers again.
Yeah, Mark, that's 100% right. And you know, with the interim final rule that came out Thursday night, the one of the things that they did change a little bit within that rule was previously they had this crazy calculation of what your headcount, what your FTE headcount was last year at the same period, or if you had seasonal employees, what it was between March 1st to June 30th of 2019, and they were looking for you to take that headcount and that average and then trying to reestablish it in your payroll protection loan. They changed that language a little bit at the interim final rule, where now it says that you maintain your headcount and your salary in order to get loan forgiveness on the back end. So it looks to me like what we're seeing now is a lot of the banks are looking more at what was your head count pre-coronavirus. And the intent here is, as Mark said, they want to get the money to the small businesses to get these people back on payroll. So as Mark said, we've heard a lot from clients coming back to us saying, well, you know, I had to lay these people off because they just don't, I don't know what I can have them do because of the type of business that I have. The fact is they want you to get them back into your payroll and off of unemployment, whether state unemployment or federal unemployment. The whole intent is to get them back employed because the government is of the mindset that the economy can possibly reopen up by June 30th into the third quarter. Having those people in place, then that would allow the economy to ramp up much quicker.
And the other aspect of this is unemployment systems, which are administered by each and every state, are completely overwhelmed. So there's a huge backlog there with people applying for unemployment. So part of the point of this is to get people out of those systems, get them back on their employer's payroll to free up the unemployment systems to get money out to those people who are truly laid off and are not eligible to be paid under the Paycheck Protection loans. So,
absolutely, Mark. Going into the next question there, the one thing that we do know, talking about how the banks are moving very quickly, as of yesterday, we do know that banks have funded, or not funded, but they've approved applications for at least $70 billion of this stimulus package. So, stimulus package has $349 billion in it for these loans, paycheck protection loans for a small business. You already have 20% of it funded, or at least applications approved. And according to the president yesterday, the president's gone back to Congress today to ask for an additional $250 billion to be put into this program, because it's anticipated that this program's going to run out of money and run out of money fairly quickly. So if you think about it, it was only open for what, 3 days? And within 3 days, you've already have $70 billion of applications approved. So the good chance that this, and you're not even till Friday, April 10th, when the second round of paycheck protection applications can be put in. So good chance that the $349 billion is going to run out pretty quickly.
Yeah, that's what I was just going to say. We haven't even, the window hasn't even opened for everyone to apply yet. And so, yeah, the question is, will the money run out? Yes, it's going to run out. We don't know when. So we've had some clients say, well, I don't have anything for my people to do right now, but I think in a month I might. So if I get the loan now and pay them now, then I'm going to run out of money. I'm not going to be able to pay them a month from now when I actually need them to do the work. I would not roll that dice. So if you can apply now and get the money now, I would take it while it's there, because a month from now it may not be there.
It might not be there. Exactly, Mark. I've had a number of clients too say the same thing, and I've been advising them with I would apply for it now and get the money versus wait, because it might not be there. No guarantees.
Yep. All right, Dave, do you want to go over the lessons we've learned so far?
Yeah, sure. So one thing, the first item there talks about maintain documentation supporting amounts and decisions made in the application. The banks are requiring that when you perform the calculation of, quote, payroll cost, unquote, that you have the appropriate documentation. That documentation is being submitted to the bank. And what we mean by appropriate documentation is specifically on the payroll side, because really at the end of the day, payroll cost, being salaries, wages, that is really the biggest number. They're looking for your 940, quarterly 941s, some type of year-end tax report, and having that data and documentation that will tie back into your application for your loan. All the banks are asking for that information because they need some tax data to work from. Now, the bigger issue here is, what is the time period you should be working from? And what we're seeing is all the banks appear to be working somewhat differently in regards to the time period to work from. The application itself says, quote, most companies will use 2019 data. And that would make sense because most companies at this point in time would have all of their quarterly 941s and their year-end 940 filed for 2019. Some banks are asking for, according to as the Act reads, the trailing 12 months of payroll data, because the Act does actually read, and it does say that payroll is based on the trailing 12 months average per month at loan origination. So some banks are asking you actually to go back and look at things from at least February 2020 back to March of 2019. So that is, we're advising our clients right now to, I would go with the idea of using 2019 data, but I would also make sure that you have January and February 2020 data by employee from your payroll reports and from your payroll providers. The one thing that I do know is this, is that all the payroll providers have been very, very good at providing the data as requested in the Act. Whether you're using any of the larger payroll providers like ADP, Paychex, or Paytime, they definitely can produce that information and give that information to you that you can fill out the application and use the gross salary numbers. So those payroll providers are definitely ramping up. So that is the one thing we want to make sure is that you're maintaining, having that documentation ready to go and submitting that with the application.
Yeah, like Dave said, we're telling people have all of the information available ready to go, because at the end of the day, to a certain extent, it doesn't matter what the CARES Act says. It doesn't matter what the interim final rules say. You're going through the bank, and the bank is the one who's going to be approving the loan. So if you can't get them the information they're asking for, they can't approve your loan. So you're probably going to need to jump through some hoops that otherwise you may not have to jump through.
Yeah, absolutely. The other thing too to keep in mind here is that you got to think about how many applications these banks are handling at one time. So what the banks are really focused on the verifications that the borrower is making that the information is accurate. And you'll see that on the application where it goes down that list of things that I'm going to be using the money for payroll costs. I have an economic need for the money to support my business, and there's a list of certifications that you actually have to sign off on. The bank at the end of the day is really relying heavily on those certifications. They want the detailed documentation, but they are relying on the borrower's certifications for that information. So that's, the banks are all doing the best they can with the amount of applications that are coming through. And it's really reliant on the applicant to make sure that information is certified and accurate to the best of their ability. The other thing too is, if we can just switch back there to that last slide there real quick. I think we're still off. I think we're going ahead too far. There we go. So the other thing too is to keep in mind that what we're seeing is that there's many different interpretations of what payroll costs actually are, resulting in significant differences in the calculation. And we're going to talk a little bit about what those differences in payroll costs that we're seeing are. So the way the Act reads is it says, the Act says that payroll cost is compensation in the form of salary, wages. It would be tips, it would be commissions, it would be benefits that are being paid by the employer that are in a group health plan or some type of insurance. It talks about 401k or retirement contributions being made into the plan. And what we're seeing is that there is some confusion around the payroll cost piece. For the loan calculation piece, what we're seeing is that, or what we have identified is that it's gross compensation coming off of the 940 or 941 reports. It's not the net compensation. It's not after taxes. It's the gross compensation is part of the calculation to figure out payroll cost. That has been some confusion in the marketplace, even with the banks. Some of the banks we've seen are excluding taxes, but the way the act reads is that the act reads that taxes are excluded for the period of February 15th of 2020 to June 30th of 2020. The reason why they set those dates is because when you go for loan forgiveness, you're going to exclude the taxes. But for setting the loan, they want to set the loan on the gross compensation, because that's what the actual outlay of cash is going to be by the business over that 12-month reporting period that you're looking back and looking at your average cost. So that we just want to get some make sure everybody has clarification on that. Even the AICPA came out with guidance on this over the weekend. It said the exact same thing, that its gross compensation is what is to be in the calculation for payroll cost. I think now we can go to the next slide. There we go. So again, payroll costs are not to be reduced by taxes imposed on the employee and required to be withheld by the employer, just like we just talked about. This is for just calculating the loan. The loan forgiveness piece is completely different. It's going to take the payroll costs, but you're going to exclude the taxes in that calculation for the loan forgiveness piece.
And I do want to touch on that. We saw one bank say that payroll costs needed to be pulled out. And in their defense, the interim final rule, there is a clause in there that is extremely confusing that suggests that they should be pulled out for the payroll costs from, I think, the period February 15th through June 30th.
Yep.
Well, if you don't know what your payroll is going to be and how much you're going to be able to pay people from February 15th to June 30th, how do you know what number to pull out? So, you know, that's an obvious problem, and it's inconsistent with the actual text of the law. But fortunately, we've only seen one bank do that. However, if that's your bank and you can't go through anyone else, because most banks are saying if you don't have a banking relationship with us, we're not gonna accept your application. If you're locked into that bank, unfortunately, you got to play by their rules, because it's either you get a lesser loan amount or you get nothing. And because the numbers are divided by 12 and then multiplied times 2.5, what might look like a big number gross may not be that big of a number when you're talking about just 8 weeks worth of payroll. So just keep all of that in mind.
Mark, dead on. The other thing is we talked about a little bit earlier here too is the time period that the banks are looking at. Some banks are looking at using the trailing 12 months of your payroll costs, and some banks want to see the 2019 data. 2019 data might tie more clearly into 940 and 941 tax returns, or if you have an audit or review or compilation, or you have a year-end financial statement done for your company, it might have a little bit clearer tie-in to the group benefit cost, any types of contributions you made to retirement plans, that type of information. So that is, again, really up to the bank, and you're going to have to just work with what your bank wants to work with and they feel most comfortable working with, because it is a little bit of confusing guidance there between what the application says and what is actually in the interim final rule. The other thing relates to this whole thing with this $100,000 annual salary max. So I've seen calculations, Mark, from clients that have sent it to me where they're calculating the gross pay and then they're throwing in what the benefit cost is per person, what contributions to 401k per person, and then they're saying, okay, well, they're over 100,000, so I'm going to extract everything over that 100,000 mark. No. Exactly. Based upon what we're seeing and the way the act actually reads, is it's 100,000 is the exclusion on the gross compensation. If you have a group benefit plan, or you have a benefit plan like an insurance plan, or you as an employer are making a certain contribution to the employees in the employee's funded 401k plan, that is all separate from the calculation of the $100,000. The $100,000 is truly based on just your on that employee's compensation.
So if you have an employee making $120,000 a year, and you also pay for their health insurance, which is another $20,000 a year, so the total is 140. You do not get rid of the entire $40,000. You get rid of the 20, which is just the salary over the 100, and then but you still get the health insurance on top of the 100. The health insurance can take you over 100. Salary cannot take you over 100.
Yeah, and I think the reason why you see it that way in the guidance is because they're saying the group health plans are of cost to the whole company. No matter what your salary level is, it's a cost to the whole company. So we want to take that cost, compartmentalize it, and show it separately in the calculation. The other thing too that is curious, that we saw a significant change on between the guidance and what we saw Thursday night last week, is this thing with independent contractors. So before Thursday night, when the New World Order came out, there is this thing about independent contractors were included in the calculation of payroll cost. And it was thought at the time that you would pick up the independent contractors as not just part of their 1099s as payroll, but also as part of the headcount. That was a sweeping change on Thursday night that came out, and it was very explicitly laid out in the act in accordance to the interim final rule, where it says independent contractors are not to be included in your payroll cost, and that independent contractors can go file for their own PPP loan. Interesting.
That's right. And I want to take a minute now and kind of go rogue. Sorry, Dave.
That's okay.
To touch on the difference between a business, a sole proprietorship, an independent contractor, because there's been a lot of confusion over this. And technically, actually, now that I read this last point on this slide, sole proprietors, that should not read sole proprietors. Sole proprietors can apply now. So employers and sole proprietors, the window opened on April 3rd. Independent contractors and self-employed opens on the 10th. So there's a very subtle difference between self-employed and sole proprietor, but that difference determines whether you can file or you can apply on the 10th or the 3rd. So let's just run through some common scenarios. So if you're a C corporation, you're just an employer, you have an employees, your payroll would be whatever you pay all of your employees. If you're an S corporation, same thing. You have employees. If you're a shareholder employee, you are one of those employees. You as an S corporation, the S corporation as the employer applies for these loans, and your window opened on April 3rd. If you are taxed, if all of the income from your business is taxed on your Schedule C, and you do not have an LLC in place, you are a sole proprietor, your window opened on April 3rd. Sole proprietor is the base default taxation scenario. So if you do not have an LLC in place and all the checks you get are just made out to you personally, you're a sole proprietor, your window opened on April 3rd. If you have an LLC and you are the only owner, the only member of that LLC, you are a single member LLC, you are considered self-employed, and your window opens on April 10th. So that's the difference between sole proprietor and self-employed. It's whether or not you have an LLC in place. Independent contractors. So if you're an independent contractor and you just get paid, whatever, those costs from the person that's paying you, that's not included in their payroll costs. But your self-employment income as that independent contractor, that's what you pick up and are eligible for the loan for. And as an independent contractor, usually you're either a sole proprietor or self-employed. So that's where the interplay between those comes in. If you're an independent contractor, you have to figure out whether you're a sole proprietor or you're self-employed, and either apply now if you're a sole proprietor or apply on Friday if you're self-employed.
Yes, and the one thing that we've kind of talked about too was the fact of, as Mark said, if you're a sole proprietor and you have payroll, and you're an LLC and you have payroll, and you're just going through a payroll company, you have your own EIN number, yes, you can apply now. But if you're an independent contractor, you're kind of on your own, everything runs through your Schedule C, then that's going to be an April 10th type of scenario that you're going to have to apply. And that's going to be interesting too, Mark, in regards to what the banks are going to be looking for in regards to, as it comes to justification of the income in the loan amount that you want to get from the bank when it gets to April 10th. I'm expecting that we're going to probably see some type of guidance of some sort here in the next 48 hours before that window opens up, because it's going to be a free-for-all. I mean, I'm not sure exactly what they're going to work from. Is it going to be 2019 tax returns? What if your 2019 return is not filed yet? Is it going to be some type of schedule of what your 1099 income was, or is it going to be, hey, you can go back and use your 2018 return? I've been fielding a lot of those questions here recently, and you know, it's kind of hard. It's kind of hard to know, because who knows?
And unfortunately, I think it's going to vary depending on the bank. So that's why we're going to make the point again: contact your bank early and often. Get all of your information together, every single piece of supporting documentation information that you have. If you receive 1099s, you should have received all of those already from 2019. Add them up, get an Excel spreadsheet together that you can give to the bank. And at the end of the day, the interim final rule made it very clear banks can rely on the information that you give them. They don't have to independently audit or verify the information. The onus is on you, the independent contractor, sole proprietor, self-employed, or business, to give them the appropriate information. The onus is on you. They can rely on whatever you give them. So don't screw this up.
Absolutely. Let's advance over here to the next slide. Okay, non-seasonal headcount may be based on average employment over the same time period. Again, we're looking at basically the headcount requirement that's inside the Act talks about maintaining headcount and salary costs that would have been before your application. So more likely than not, they're going to be looking at what was your headcount at the end of February or sometime in February before the coronavirus crisis occurred, and that will be the number that goes on your application. And then as you go to loan forgiveness, in that 8-week look back window, they're going to look at what did you maintain headcount? Did you bring that any headcount back that you laid off? And what was your salary cost? So that they're going to be looking for that type of average employment over that same period. The other thing here is kind of important to talk about is these affiliation rules. We've been seeing a lot of this as well. A lot of questions with, what can we apply for one PPP loan, or should it be 2 or 3 PPP loans? Because we have an organization that has 3 different entities. They have 3 different taxing numbers. They have common management. They have common ownership structure. And if we were to look at them combined together from a headcount perspective, we would be over that threshold of 500. Or do we look at them separately? So a lot of, for those organizations that have a number of different entities that have common ownership, you really do need to get familiar with the affiliation rules, because those affiliation rules may kick you out of the PPP opportunity, or maybe you'll be okay and you can file for a PPP loan for all the different entities that you have.
Yeah, there's a small segment of that business population where they're at 550 employees. If you group together all the companies, my sense is this is going to be one of those things where if it looks like a duck and quacks like a duck, then it's probably a duck. So if you have 3 companies, all of which you own 100%, and you tell everybody what to do, and you don't have separate bank accounts, and you just move money back and forth between the entities, those 3 entities are going to be affiliated together for purposes of the 500 employee test. If you have 3 entities and each of them have 100 employees, so yeah, they're all affiliated, but altogether you only have 300 employees. How you file for the PPP loan, I don't think we have specific guidance on that. Do we, Dave? I mean,
No, not that I'm aware of. Yeah. I haven't
if
seen anything out there that, from the SBA or anything
yeah.
like that in regard to that.
So maybe and again, it probably depends on the bank. If you have 3 different entities with 3 EINs and each different entity pays its employees separately, and you have an employee of one company gets a W-2 with one EIN on it, and the employee of another company gets a W-2 with a different EIN on it, then you're probably filing as 3 separate companies. If all of your employees get one W-2 from a common paymaster with one EIN on it, then you're probably filing as one. But that's going to be up to the bank at the end of the day.
Yeah, exactly. I mean, a lot of times we see these entities that have different EIN numbers and have payroll going through the different EIN numbers, even though they might have common management or common ownership structure. It probably makes sense to file them separately because you have separate EIN numbers for them, and it will be clear for the bank. But again, as Mark said, I think it's going to come down to the preference of the bank. Everybody has to understand that, because this is a 7A loan situation, it's the banks that have to administer it, and it's ultimately the banks that have some of the risk here in regards to making sure that the applicant meets the requirements of the loan. So bottom line is the banks might do things differently, but it's going to be their call. What risks they're willing to take internally.
Exactly. All right, so I feel like we've killed the PPP loans.
Yeah, I think
let's
so
move
too.
on. Let's move on to EIDL because we want to get through EIDL quickly, and then there's a chart included in the slides that compares the EIDL and the PPP that you can refer back to. I don't think it's worth us spending a lot of time on that because it's right there for you to read. I think we want to get through the EIDL, and then we have questions piling up over here, so we want to save as much time as we can to go through these questions one by one.
Okay, so the other option everybody has out there is this economic injury disaster loan, or what is referred to as an EIDL, and typically this is an SBA administered loan. So that's the first thing that's different about this in the program versus a paycheck protection loan. Paycheck protection loans are administered by banks. This is administered by the SBA. You would apply through the SBA. Now, with the CARES Act that was passed on March 27th, there was these EIDL loans, that have been out there for a while, because you typically see these when it comes to like natural disasters, floods, hurricanes, anything of that nature. They're typically out there for businesses to get them reestablished, get them up and running, give them working capital to get the business going. It's usually based off lost, what is the economic uncertainty that caused your lost revenue. With the passage of the CARES Act on March 27th, the EIDL loan was opened up with loosened restrictions for businesses in this COVID-19 environment. Even though there's not a physical damage situation to your property or something like that, they opened it up because there is significant loss of opportunity or operations that could have a long-term impact on a lot of businesses. So let's go on to the next slide there real quick, and we'll talk a little bit more. So the terms of the EIDL loan are pretty set here. It's a fixed loan. It's usually fixed terms. It's usually 30 years fixed. If you are a for-profit entity, the interest rate is around 3.75%. If you're a nonprofit entity, it's 2.75%. So as you can see already, pretty favorable terms for long-term debt with those types of interest rates and being able to term out your debt. So we're going to talk a little bit about this difference against the Paycheck Protection Loan. Was the Paycheck Protection Loan, wow, the interest rate's only 1% on any unforgiven debt. That unforgiven debt, though, on the Paycheck Protection side would have to be paid back in 2 years. So could be a big number depending on how you use that payroll. The other thing that's nice about this EIDL loan or EIDL is the fact that you could get an emergency cash advance of $10,000, and typically that money can get distributed within 3 business days. It's great for those organizations that they just need cash. I need cash because I gotta make payroll tomorrow and I don't have enough cash, or I gotta make payroll in 3 days and I don't have enough cash. It's great for those types of organizations. And the nice thing about that advance is the fact that it is looked at as like a grant. It's not, you don't have to pay it back. It's looked at as a grant. It's not included in the loan proceeds or in the actual loan payback. It's really an advance or a grant of money to your business to use to give you cash to operate in the very, very short term until they can finalize the terms of an EIDL.
Yeah, so long story short, with the EIDL, you get $10,000 just for applying. Even if your loan is denied, you still get the $10,000 and you don't have to pay it back. So obvious advantage there. One question we hear over and over and over again, and we see some confusion with the banks on how the EIDL and the PPP play together. You can do both. There's a common misconception out there that you can't. You can do both. If you already have an EIDL loan, before, I think it's after February 15th and before April 3rd, and you apply for a PPP, you're going to have to roll them in together, but that's fine. You still have the money. If you haven't gotten an EIDL yet, you can still get an EIDL and get a PPP. They just have to be used for different things. So what we're telling people is, if you want to do both, get the PPP, use that 100% for your payroll. Go get the EIDL, use that for all of your operating costs. And two, I'm seeing a lot of scenarios where single owner of an S Corp, sole employee. So you run a business, you're an S Corp, you pay yourself a salary, you're the only employee. For tax purposes, for income tax purposes, before anyone even cared about COVID-19, you were going to keep your salary as low as you could, but still following the reasonable compensation rules. Well, now that's a problem, because if you were only paying yourself $50,000 a year, the loan you're going to get is only going to be, roughly 20% of that. So you're only going to get $10,000 from the PPP loan. Well, that's not enough. So yeah, sure, great, go get the PPP loan, but that's not going to save your business. You're going to need to look at this EIDL too. And obviously PPP can be forgiven, EIDL cannot, with the exception of the $10,000. But I mean, good grief, 30 years, 3.75%. I feel like that's a win.
Yeah, Mark, just to kind of expand on a couple things there real quick. Keep in mind, the PPP loan is meant for short-term financing of payroll costs for your employees to bring your people back. It was never meant to be a long-term debt program. Hence the reason why there's a 2-year term to pay back any unforgiven piece of it. And also hence the reason why there is a forgivable piece to it, because the forgivable piece to it is basically saying, if we can get these people off of unemployment and get them off the state unemployment rolls, and we don't have to pay the extra federal unemployment, and we get people back into payroll, it's kind of a, it's kind of a 6 of one, half dozen of the other type of thing. I mean, you're getting people back to work, you're getting people on the payrolls, and you're getting them off of unemployment. The EIDL loan is truly meant for long-term economic issues that your business is going to encounter or might encounter from this COVID-19 event, where it's meant to give you working capital to pay debt, to pay operating costs, to pay long-term debt you might have, or some type of capital structure over a longer period of time to allow you to get back on your feet. So that's really the difference between both of them that we're going to talk about here in a second.
Yeah. So Dave, can you quickly talk about the EIDL application process?
Yeah, so I just worked with a client on this the other day. If you go onto the SBA website, right on the front of the SBA website, there is a page for COVID-19, and you hit that COVID-19 webpage, and it will take you into the different processes that are out there. They will talk about the Paycheck Protection Loan and how that works. And then there's also got to be a link for the Economic Injury Disaster Loan. When you go into that link, it will give you the whole application process for the EIDL loan. I worked with a client yesterday that we were able to do the application process in about 10 or 15 minutes. It's a pretty simple process, a little bit more involved in regards to the questions than you would see on the Paycheck Protection Loan application. But you can get through that process pretty quickly right on the SBA website. Now, the one thing that they're going to ask for with the SBA, because it's an SBA loan, is more likely than not they're going to ask for you to come back to them at some point in time with financial statements for the company, tax returns for the company. There might be, depending on what we're seeing, some limited guarantees that may need to be made by the owner of the business, and that information would need to be provided to the SBA. But to just get through the initial application process, to get your application into the mix, it's really, you go just right onto the SBA website, and it makes sense too that you would go on the SBA website because it's an SBA loan administered by the SBA.
That's right. So here are the slides of the comparison of EIDL versus PPP. I mean, I'm good with people kind of being able to read this on their own. Hopefully this is self-explanatory. We can come back to this if we have time, but I feel like maybe we're best served to start running through these questions. Dave, what do you think?
Yeah, I mean, I think there's just a couple things we do want to make sure that we hit on this slide. First thing is the application process itself. You can apply for the EIDL loan all the way through December 31 of this year. Keep in mind the payroll protection loan, that application process runs out on June 30th. Okay, so everybody needs to be aware of that, that application process and how that works. Okay. We talked about the affiliation rules. We talked about, we've kind of beaten over the head who's eligible. I mean, for EIDL loan, it's going to be businesses 500 and less of employee counts, similar to what you see with the payroll protection loan. And the other thing that's kind of important here to note too is that the maximum amount of the loan. So for an EIDL, the maximum amount you can get is up to $2 million. For a paycheck protection loan, the maximum, depending on the size of your business, you could get up to $10 million on that paycheck protection loan. So there is some size limitations on the EIDL side that, versus the paycheck protection side. Something to keep in mind long term. I think most of the clients that we have, I haven't seen a client that had over $1 million actually I can think of one client that had over $1 million requested on a paycheck protection loan, but it's something to keep in mind that the maximum amount you can get on an EIDL loan is $2 million versus the $10 million on a paycheck protection loan. And we talked about the advances and everything like that in the maximum loan amount. So I guess we could just flip to the next page there. We talked about the interest rates. We talked about the maximum term of the loan. The deferral portion is something that we should just hit on very quickly. So with a EIDL, the first year of payments can be deferred. It will accrue interest from loan origination, but the first year of payments can be deferred. So again, the whole intent there is to make sure that everybody has cash available. They don't feel strapped with having to make debt and interest payments right away to get their businesses up and running. The paycheck protection loan, it's only the first 6 months that's deferred. And also keep in mind, again, the paycheck protection loan, it's only a 2-year loan. So if you have $1 million that you got for the paycheck protection loan and you can only prove loan forgiveness of $750,000 of it, so you're left with $250,000, that $250,000 is accruing interest from the date of origination. You got to pay it back in 2 years. So that's something to keep in mind. That's kind of important to between both of those different loans. We talked about the loan forgiveness piece. There's obviously loan forgiveness with the paycheck protection versus the EIDL loan, which is a traditional long-term debt finance piece. Collateral, I think the last thing is important here is no collateral. Again, there's no collateral on a paycheck protection loan, but with an EIDL loan, there might be some collateral that may be needed. It depends on what the SBA is asking for. And yes, do you have to give personal guarantees? For a EIDL, yes, there would be personal guarantees. Going back to what I talked about earlier, typically the SBA is going to ask you for, if there's personal guarantees, probably have a personal financial statement of some sort with your personal assets, since it would have some personal guarantees if the loan is greater than $200,000. So it's something to compare and contrast the need for between the paycheck protection and the EIDL, but both those programs are out there. They're both to be utilized by businesses that have been impacted by COVID-19, and both programs are meant to help you establish your business and continue to keep moving long term. So Mark, you want to get in some questions here so we can see if we can address some questions?
Let's do it. All right. So let's see. If there's an opportunity for a local county grant for a small business, would this affect eligibility or securing funds through the CARES Act? I'm not aware of anything.
Yeah, exactly. I know that in Pennsylvania, the Pennsylvania Industrial Development Authority and the Commonwealth Financing Agency had that $100,000 money that was out there for small business, and I do not know if that, I have not heard of that impacting your ability to apply for either of these loans. Definitely not the Paycheck Protection Loan, but I don't think it impacts either the Economic Injury Disaster Loan.
That's right. Will part-time employees be considered in PPP loan forgiveness when there are no full-time employees?
You know, that's a good question. Because the way the act reads is it talks about full-time equivalents. So I would think that in regards to loan forgiveness with those part-time employees, you would have to come up with some type of calculation of sorts of what your full-time equivalent would be, or what what an FTE would actually look like. So if you had 8 part-time employees all working 20 hours a week, the equivalent of that's probably 4 FTEs, because they're going to probably want to look at that and look at the salary cost at the same time. I mean, that's a good question. I mean, that's one that I would wonder if that's like more of a seasonal business, and that has more impact on the seasonal calculation.
Yeah, the interim final rule, they did simplify it a little bit, like you had mentioned, Dave, where the kind of the blanket statement, if you maintain headcount and maintain salary levels, it's going to be forgiven. So my sense is, one of two things. You're going to say we had 10 part-time employees before this whole thing started. After the end of our Paycheck Protection Loan period, 8 weeks, we have 10 part-time employees. We pay them the same amount that we were paying them before. You're probably going to be good whether you measure it via headcount or compensation level, or if you measure it via FTE, you'd get to the same answer. So I feel like you should be good.
Yeah, because I think on the application, correct me if I'm wrong, it doesn't say where it says headcount number. It doesn't say full-time headcount. I think it just says what's your total employee count.
Yeah, I think it actually says number of jobs, unless they changed it.
They changed that. They
Okay.
changed that. It doesn't say number of jobs anymore, but I don't think it says full-time head count. I think it just says what's your head count number.
All right. So next question. Are vision and dental costs included in payroll costs?
Yes, it is. If it's part of a group health plan where you have vision and dental offered as part of the typical health insurance, that would be included as part of your payroll costs. So you would want to make sure that you pick that up as well.
And is that part of the health insurance costs where that can take you over the $100,000 limit?
I don't think so. I mean, it would just be part of, when you look at the act reads health insurance cost or in premiums paid. So health insurance cost to me would include not just health, it would include the dental and the eye insurance that would be included in any types of group health plan that you offer to your employees. So you want to include that into someone's gross salary. It would be separate, and you would look at that separate from the premiums that the business is paying.
Got it. How does it work if I own my own business and have been working primarily with one client, and that client has now dismissed me during the crisis? Can I apply for PPP to keep myself employed? How does that work?
So I guess the question would be, were you an employee of the business, or were you a 1099 subcontractor? I guess is the question.
Yeah, that goes back to, I think the short answer is, yes, you can apply for the PPP loan because, so you're self-employed or you're an independent, well, if you're self-employed, you're an independent contractor. But if you're self-employed or a sole proprietor, you have to get that information that shows, what your self-employment income was, what you were paying yourself. Again, we go back to, are you an S Corp, or are you an LLC, or are you a sole proprietor? But yes, you would be eligible for this.
I see another question that came in and said, what period of time is the measured for the 8 weeks? So the 8-week period of time for loan forgiveness is measured from the loan origination date out 8 weeks from that period. So if your loan origination date is April 15th and you signed all your documents and you were funded, it would be measured from that period out 8 weeks. So it'd be June 15th, and they would look at that 8-week period window to determine that A, you maintained headcount or you brought laid off headcount back from pre-coronavirus time period, and that you maintained payroll cost consistent with what you had before the crisis started. So now one thing I think is important to note is one of the things that did change pretty significantly, and we didn't really touch base on this, Mark, was the fact that the guidance was very explicit that came out Thursday. It talked about at a minimum 75% of whatever loan that you get has to be spent on payroll cost, and no more than 25% of that loan could be spent on rents, utilities, and interest on mortgage debt or interest on other types of debt. That was a big change from any other guidance that might have been out there that came out Thursday night. So that would be the one thing that everybody has to keep in mind is, we're focusing a lot on this headcount thing, but really at the end of the day, it's going to be you got money and you have to spend it on payroll.
That's right. So next question, if I am approved, do I need to wait to receive the money before bringing employees back? No, but I don't know if they're going to come back if you can't pay them because you don't have the money yet. So I don't,
yeah, exactly.
I don't think that's
I think though
they're independent. I think.
Yeah, I think maybe the question there was, if I know I'm going to get funded on the 15th, could I bring them back now? And if they get paid every other week, yeah, I mean, you could if you want to. I don't think it really matters when you want to bring them back.
Yeah.
So.
I currently bank at bank to be unnamed. As of today, they still do not have the portal open for the PPP program. I was told sometime this week, but my concern is my loan won't get approved. Should I be looking at another bank? Yes. Problem is,
exactly.
it all depends on what bank is going to be taking customers that they don't have a current relationship with. If you have relationships with multiple banks, yeah, be talking to every bank who will talk to you. If you only have one, they're not open yet on this, yeah, start making phone calls, checking websites to see who else will talk to you.
Yeah, absolutely. I mean, most of these banks now, because of the amount of applications, are only accepting bank or relationships that they currently have inside the bank. And the other thing too that's important to note, Mark, is I've run into this with a couple people this week, is that just because you have a bank, a relationship with a bank, and it's a depository relationship where you're just depositing cash in there and cutting checks, a lot of banks, those banks may still not work with you because they're looking for you having had in the past some type of credit relationship, and that credit relationship might be a typical loan, or it might just be a credit card, but they're looking for some type of credit relationship because that will prove your ability to pay back debt or to pay back loans because you had a credit relationship with them. That is something I've run into this past week, Mark, with a couple clients that have gone back to their current bank that they have a depository with, and the bank is him hauling around and working with them because they don't have any credit with them.
Yeah. So next question, what if you get the money now and bring employees back and pay them until you reopen? You pay them for 6 to 8 weeks and then they quit after the 6 to 8 weeks. I say shame on them, but I don't think that affects anything, does it, Dave?
No, I don't think so either, because it's the calculation. You spent the money on payroll, and it shouldn't impact your loan forgiveness.
Yep. Next question. If an employee asks to have their pay suspended, but they are still working, can the employer use loan funds to catch up their pay within the 8-week period? I wouldn't see why not. Still on payroll, right?
Yeah, I mean, again, it's going to show you spent the money on payroll, right? So I don't see that being an issue. If you let people go and you want to make up for their payroll for what, when you let them go a couple weeks ago and you brought them back, as long as it's showing that you spent it in payroll and you've reestablished headcount, I don't see that being an issue.
Yeah, I think of the S corporation sole owner, shareholder, employee. Obviously, you probably haven't been paying yourself for the past month. So yeah, you can catch yourself up as long as it's being spent on payroll. That's fine. All right, next question. If employees are being paid under the PPP but staying home or working from home, is workers' compensation calculated different than when employees are in the office/field?
You know, I don't know if I have an answer to that one, Mark, because I'm not a workers' compensation specialist. I mean, I think that that's really dependent on how the carrier looks at it or how the state looks at it from the Employment Compensation Fund. I don't know. I would think that that's probably not going to change even if they're working from home on a short-term basis. If for some reason your industry changed dramatically because of the face of this, that people are now working from home, it might change your workers' compensation rate. But I don't know, Mark. That's probably more of an insurance question that an agent or a carrier can answer.
Agreed. Another bank question here. I bank with Bank X. Do I go through them? Yes, that should be your first shot. The bank mentioned here is one of the larger banks. It says, I recall seeing a list of participating banks and they were not on the list. I'd look again. The bank should be on the list. Most of the big banks are on there. Check their website. Usually, pretty much every bank, if you go on their website now, the first thing you see is some banner that says PPP COVID-19. Click on that. That should get you through there. But again, if your bank isn't working with you, call another bank.
Absolutely, I wouldn't wait around. I'd be looking around at different banks that are actively working on this right now.
Next question. Most of my employees are part-time, but I will lose them if they are not getting work. Can they be paid with the PPP loan? Yes.
Yes.
Can an owner of two companies apply for the PPA loan for both companies? Will applying for both companies hurt the chances of being approved? This goes back to our talk about the affiliation rules. If you have two companies and you have two payroll systems where employees of each company are getting W-2s from different EINs, I would see no problem applying for both companies. If employees of both companies are paid out of one company, I would just apply through the company that has all the payroll. Because again, as long as you're under 500 employees for both companies combined, what they're going to look at is payroll cost, and you're going to need to produce 940s, 941s. So if you have two companies, you either group them together, go to the bank, and they might say you're going to need to do two loan apps because you have two payroll systems with different EINs. If they're all under one EIN, they'll probably just have you do one. Has the filing of first quarter payroll taxes been delayed, or do they need to be filed and paid by the due date? All payroll taxes, at least the Social Security portion, are deferred until 50% are deferred until the end of 2021. Another 50% are deferred until 2022. But yeah, we're now getting into the stuff that I haven't looked at for a few days because obviously that's not the hot button issue right now. But you should be able to Google that or go on the IRS's website and get more specific information on that pretty quickly. Do 1099 contract employees or 1099 independent contractors count toward the payroll cost expense? No, because they are able to apply for PPP loans on their own.
Exactly.
Are you saying the loan is based on gross compensation, but the forgiveness is based on net payroll?
So the way the act reads is that yes, the loan calculation is based on the gross payroll, but if you read the act, it says excludes payroll taxes for the time period between February 15th of 2020 and June 30th of 2020. So when you go to calculate what your loan forgiveness piece is going to be, it's going to be the gross less the taxes.
That's right. Next question. How will you qualify for full forgiveness when the loan is for 10 weeks payroll, but you only have 8 weeks to spend it? So this goes back to the 75% piece. That's why they're saying only 75% of the loan proceeds need to be spent on payroll, and that's why they did the 2 divided by 12 multiplied times 2.5 as opposed to just multiplying times 2, because they get that you're going to need this not just for payroll, but for other costs that are eligible costs. But yeah, as long as 75% is spent on payroll, you can use the other 25% for mortgage interest, utilities, and rent. Does company match need to be done with each payroll to be included, or is it okay to include even if paid annually? I think
Paid
both are
annually
okay.
is, yeah, both are okay.
Are employer contributions to benefits only for medical insurance and retirement, or does it include dental, vision, and life? Includes all of them.
Yeah, includes all that. I think we covered that earlier.
We are a partnership with employees and K1 owners. Can we include owners draw up to $100,000 each in our payroll costs? Oh boy.
So I think we have to look at what the definition of draw is, because typically a draw is against previously taxed income, so that wouldn't be included. But if it's guaranteed payments would it be included? Is that correct, Mark?
Yeah. So, and this brings up another issue. When I read the CARES Act, the law says if I'm a partner in a partnership and I'm getting guaranteed payments, that is not included in my payroll costs. And I would, as a partner, I'm self-employed. I would need to go out and file and apply separately. And other accounting firms that I've talked to, that is the guidance that they're giving their clients. We talked to an SBA lender, or not an SBA lender, an official with the SBA, and we were told no, guaranteed payments are included in your payroll costs. So while it's inconsistent with the law, I think someone at some point said, good grief, if we don't allow all these partnerships to include guaranteed payments in with their payroll costs, that's going to quadruple the number of applications we have to process. So we're just going to let them include guaranteed payments. But it's important to distinguish between guaranteed payments and distributions. Guaranteed payments, I'm going to say yes on. Distributions, I'm going to say most likely not.
Yeah, and just to add to that quickly, Mark, is that when the SBA came out with this thing on guaranteed payments, their thinking on why the guaranteed payments would be included is that they said if you are directly involved in the business, and this is a direct, and this is compensation that's for direct services you're providing to your business, yes, those guaranteed payments would be included. So we have seen a number of clients of ours that have owners that are getting guaranteed payments, directly involved in the business, have direct operations inside the business. They put their guaranteed payments in their PPP application. They've been approved by the bank that they went through, and that's different banks that we've talked to. But the way the SBA said it is that you have to be directly working for the business.
Good clarification. Are we aware if our banks are assigned a specific amount of SBA loans they can process because they're being told that they're going to run out and they won't receive funding? I've heard nothing of the sort.
I haven't heard anything of the sort either. I think these banks are looking at this from the perspective of the more I can process, the more money we're going to make on the bank feed.
Yep.
So,
can you clarify if EIDL loan advance could be less than $10,000 if the employer has less than 10 employees? Everything I've read says I don't care how many employees you have, as long as you're under the 500, you get 10 grand.
Yeah, I'm seeing the same thing, Mark. Seeing the same thing.
Documentation required for health insurance premiums do not say what time frame should I break out what the company pays compared to the employee contributions.
Yeah, I think that's an important one to make sure that we cover here real quick, Mark. Is that the way we're seeing it is it says it's the cost that the employer has is what they're trying to get coverage for with the Paycheck Protection loan. So if you have a plan, a healthcare plan at $100 is the cost of the plan, 30% of it's being funded by the employees, and that the employer's paying the $70 of the $100, then it's the $70 is what is being applied on the Paycheck Protection application.
What about clients who file a Schedule C and have employees on payroll? When do they apply? That goes back to, are you self-employed or are you a sole proprietor? If you have an LLC in place and you're a single member LLC, then you're going to be self-employed. Your window opens on the 10th. If you do not have an LLC in place and you are a sole proprietor, then the window is already open. You can apply now. Would seasonal be considered part-time workers too?
Yeah, sure. Well, yeah, it could be. Yeah, it could be. I mean,
I don't think it matters. I don't think the distinction matters.
Yeah, I don't think it does either.
PPP versus employee retention credit. Employee retention credit can apply for EDL. You cannot do both PPP and the employee retention credit. If you're getting the payroll protection loan, the feds are going to want their all of their payroll or all of their payroll taxes. You don't get the credit. But I don't believe there's any interplay between the EIDL and the employee retention credit, just the PPP.
It's just the PPP that I've read too, Mark. I mean, and it's pretty clearly laid out in the guidance that those credits do not apply.
$10,000. I believe they changed it to up to $10,000 for the grant for the EIDL as opposed to a strict $10,000. Do you know anything about that, Dave?
I don't. I mean, I saw a client of mine the other day apply for the EIDL, and there was a pretty small client. And they requested the 10 grand. I haven't heard anything that there's some type of limitation in regards to up to $10,000.
Okay. Are you able to just get the grant and not go for a loan? I mean, in order to get the grant, you have to apply for a loan. I'm guessing maybe you could apply and give them a really bad set of facts.
You get denied. You
purposely get denied. I guess you could do that.
I mean, I could see you could apply for the loan and get the $10,000, and then I'm pretty sure you could apply for the loan, get the $10,000, and not accept the loan.
Yeah. Yes, that's a good point.
Because you could apply for a loan. You could apply for the loan and decide, well, maybe I don't need the loan because I got the Paycheck Protection grant or loan, and I'd rather take that versus taking EIDL. I mean, that could be the case, but the 10,000 is 10,000. It's a grant, and you don't have to pay that back.
With the $10,000 cash advance being considered a grant, should clients pick this up as income debt forgiveness from a tax perspective? I've researched this a ton. I have found nothing that says either way, which tells me that it would be taxable income. Under the Tax Cuts and Jobs Act, grants or capital contributions from government agencies are considered income. So my guess is that it is taxable income, but still, you know, $10,000 is $10,000. If you have to pay tax on it of $2,500, you're still moving ahead. EIDL loan, if you pay existing credit card debt to consolidate, is that allowed?
The way I see the EIDL loan is that you could do that with the EIDL loan. I mean, what the EIDL loan's whole purpose is that you've had some type of economic impact that's going to have a long-term impact to your business. They're giving you this money as working capital to help you reestablish your business and operate into the future. Part of that says that you can refinance debt, or you can use that money to pay down debt, both principal and interest. So I would think that if you have credit card debt and you went and paid that credit card debt off, that as long as that credit card debt was related to the business, I don't see why you couldn't use your EIDL loan proceeds to do that.
Yeah, that's an important distinction. It has to be business debt. If it's personal debt, you could pay yourself the payroll, as long as you don't have the PPP loan that you're paying yourself for payroll. You would just have to pick it up in income first before you pay the personal credit card debt.
Yeah, absolutely.
Max amount for EIDL, $2 million, right, Dave?
Yes.
All right. In either the PPP or EIDL programs, are the portions that are forgiven considered a grant taxable? PPP, no. EIDL, most likely. And that's the person asked about both federal and Pennsylvania. Pennsylvania has been silent on the PPP, right? But I can't imagine them making you pick it up in taxable income.
Yeah, exactly. I mean, I gotta imagine all these states are gonna follow Fed. You know what I mean? In regards to how it's gonna be handled. And
PA taxable income starts with federal taxable income,
right?
So they would have to have a specific add back. What can you tell me about the employer FICA deferral? Everybody should be eligible to have their payroll taxes deferred, but as I mentioned before, that's a different aspect of this. So we have some articles out there on our website. You can go check those out. EIDL, how do they determine an amount to approve, or just request whatever we want?
Yeah, I think the way that they determine the amount. So I think part of the application process is you have to show what the economic injury that you had from the business in regards to lost revenue, or operational costs, and I think that's how they determine the loan amount. So again, there's much more documentation that's required for the EIDL versus a Paycheck Protection loan, because they're looking for company financial statements, company tax returns from the prior years, so they can look at what that economic injury has been in regards to your business from COVID-19, so a determination can be made as to what is the amount of the loan should be to give you enough working capital to continue to move forward.
Somebody did point out we have an error in one of our slides that the PPP application period closes June 30th. I think we fixed it for the one class of applicants, but not the other. So thank you for pointing that out. The period ends June 30. Let's see. It looks like we have a bunch of repeat questions here that I'm going to skip over. If you're denied the EIDL loan, can you keep the 10 grand? Yes.
Yes. Yeah.
Is the application for independent contractors much different than others? It's all one application. You just check the box at the top that says independent contractor. If we reduced hours for employees, will that affect our loan forgiveness if we bring them back up to full-time by June 30th?
As long as you bring them back full-time by June 30th and you can prove that you use that a minimum 75% of the loan proceeds for payroll, I don't think that's going to impact your loan forgiveness.
Is there any information about allowing credit card deferment or forgiveness?
That's a good question. Credit card deferment or forgiveness, I think that's really the credit card company the credit card company wants their money. I mean, that's the bottom line. I mean, I don't think they really care about the CARES Act, the credit card company. They just want their money. Yeah.
As a self-employed LLC with no employees, how will the forgiveness be considered? Same as all the others, as long as you just pay yourself the payroll cost. As long as it's all payroll costs and you're paying yourself now what you're paying yourself before, you should be fine, or whatever. As long as you use all of the PPP loan to pay yourself and you're picking it up in taxable income as wages or self-employment income, you should be fine.
Yep.
If you receive funds through the PPP, are there any stipulations around CapEx? Not referring to the PPP funds, but spending in general after receiving funds for payroll. Go ahead.
Yeah, I mean, the way that the PPP works is that those monies have to be used for payroll, and then there's a small portion of it that has to be used for operating expenses, being rent, utilities, or interest on debt. So I don't believe you can use any of those funds for purchase of capital equipment. Now, if you got an EIDL loan, that might be a different story, because that is related to working capital and having the ability to have cash available to ramp up your business over time for injury that's occurred because of COVID-19. But for the PPP, I don't believe you can use any of that for purchasing of CapEx. You might be able to if you have a payment on some type of CapEx, you might be able to use part of it for the interest piece, but not for the principal piece of it.
Yep. I have an HVAC installation company, but no one wants my installers in their homes right now. If I get the PPP loan, do I have to bring them into work even though I have no work for them? No.
You don't have to bring them into work, but you're gonna have to. If you get the PPP loan, you got to somehow figure out how you're going to spend that money for payroll.
Yeah, I mean, you just got to pay them.
You just got to have to pay them. Yeah.
Yeah, if they're sitting at home, I don't care. That's fine.
Yeah, I mean, again, a lot of the questions that we're answering right now, Mark, are centered around the payroll, how the payroll is to be used, and keep it again. Whole intent of the loan is to get people off of unemployment, get them back into your payroll, and whether you're using them full time or not, the fact is they want them on your payroll and you're paying them through your payroll and off unemployment.
Yep. All right, we're going to go rapid fire mode here. I know we're already 15 minutes over. Can a business get either of these loans if the governor has shut them down as a non-life sustaining business? Yes.
You can get both as long as you're using them both for two different circumstances. If you can't use them both for payroll, it would have to be one or the other.
Yep. Can bonuses fall under the PPP? Yes, it's all payroll. Where again, I'm trying to skip over repeats here. If we don't address your question, it's either because we feel like we already addressed it, or we simply don't know the answer. Because there are some in here that are, I mean, there are some questions that are speculative to what happens if this goes longer than 8 weeks.
Yeah.
I have no idea. We're just gonna have to wait. They already got another 250 billion. They might go back for more. We don't know. Do we need to reestablish full headcount for payroll forgiveness? 20 people are furloughed. Do I need to bring all of them back? Yeah, I mean, the point is to get all these people back.
Yeah, because because they're going to look at what your headcount was before, and they're going to want to see that you reestablished it at the end.
We applied through a bank, but then they told us that the bank will not be doing the loan. Can we start to work with a different bank? Yes.
Yes.
I pay everyone who works for me as independent contractor and issue 1099s. Can I apply for and be forgiven for a PPP loan? No, because you have no payroll. If you're paying yourself something, you can apply for yourself as a sole proprietor or self-employed, but not for what you're paying your other independent contractors, because they're eligible to go out and apply for the loan on their own. Is any part of the EIDL non-refundable?
Non-refundable. I mean, there's no loan forgiveness on the EIDL. It's a standard 30-year loan with fixed interest rate.
Yep. Just the 10 grand that you don't have to pay back.
Yeah.
Is the only collateral for loans under 200,000 only business assets?
I don't think it's just business assets. I think it's related to working capital. Like, if whatever working capital needs you might need, it would be for that loan that's under 200,000.
I understand that the business had to break even at a minimum to qualify. What if you had a loss? I'm assuming that's for the EIDL, because they look at overall financial picture. My elementary understanding is that kind of the loan is based on gross receipts less cost of goods sold. As long as your gross margin is positive, you should be good, right?
Yeah. So, Mark, the one thing in a typical EIDL, under normal circumstances, I do believe they look at the profitability of the business. But I think when I read it, when we were reading through the details of the act that was passed and how they loosened the regulations and the restrictions for the COVID-19 situation, I don't think the issue of profitability of the business is in there anymore. But again, that could be different. I don't know for sure. I mean, until you go through the application process and the SBA starts to look at these applications.
All right. I think we're through them. We're through the questions. Dave, any parting thoughts?
Mark, we covered a lot of ground here, and I'm sure that next week we'll have to do another webinar, because the landscape will be completely different. So who knows what will happen. I will say this, Mark, the one thing that we will be doing again is on a serious note, is another webinar, because with the Paycheck Protection loan, now that you've got the loan, we're going to be talking a little bit more about how do you make sure to get the loan forgiveness, and how do you account for that on your books? How do you manage the payroll cost and ensure that it was spent properly? How do you show that you spent the money on utilities and rents and things of that nature? Because the last thing you want to be is stuck with some type of unforgiven portion of that loan and have a 2-year time window that you got to pay it back. So that will be coming up here shortly in the next week or so. We'll be advertising another webinar to talk about that. But outside of that, it's just a moving landscape right now. So everybody, please check back to our website at macpas.com, our COVID-19 page. We're continually updating that information on a day-to-day basis with new information that comes out. So.
What he said. I know there's probably still some questions out there that we haven't answered. All of our guidance is on the website. Check it out. I know there's a lot of information out there. Dig through it, and hopefully you'll be able to find the answers to your questions. If not, shoot us an email, and we'll do our best. Thank you, everyone, and we'll see you for part 3.
Thank you.